fundamental radar, we have Indian hotels. So industry demand is clearly outpacing the industry supply, and it's clearly visible from the Q1 as well. As per the STR, the overall industry demand growth in first quarter stood at 8% compared to FY20, which is much faster compared to the supply growth of 6.7%, which was witnessed in the first quarter compared to FY20. Now, the factors which are driving this demand is largely the global events which are likely to be held, like for example Miss World pageant, G20, ICC World Cup, and tourism summit which recently happened in Q1 in Goa. So these are some of the key events which is actually driving the overall domestic demand in India. In fact, G20 is expected to start in September. So in second quarter, we can witness some increase in the occupancy rates and in the overall room rentals. So domestic demand is clearly driving the growth in the sector, though the forest tourist arrival has still not yet fully come back to the flow. Some green shoots are visible, but then it's a very slow pace of recovery that we're seeing in the forest tourist arrival. So the demand is being completely led by the domestic demand currently. Now, going ahead, the Indian hotels plans to open minimum 20 hotels in FY24. If you look at its overall pipeline, then it has around 79 hotels in pipeline, which would take its total portfolio to around 270 hotels as of June end. The company is planning to follow an asset-light kind of model, and earlier it used to do more of own hotels and less of management contract hotels. Which had skewed its portfolio towards 75-25 kind of ratio and has thus put strain on the balance sheet. But now the company is looking to follow the asset-light model, and they are targeting to maintain a mix of around 50-50 so that it doesn't put strain on the balance sheet. So this would actually boost the overall profitability for the company, and overall it would drive the improvement in the margins. So if we talk about the overall numbers, so we expect revenue CAGR of around 13%, and with the improvement in margins, we are kind of expecting EBITDA and PAT growth of around 20% over next 2 years. And as we mentioned, this would be clearly driven by the improvement in the occupancy rates as well as the ARR on the back of healthy demand supply dynamics. Also the higher income from the management contracts and unlocking of value by launching the reimagined and the new brands would drive the overall profitability. So we continue to be positive on Indian hotels with a buy rating and a target price of around 500 from 1 year perspective. Thank you.